Yeah, distinguished students, we are still on capital budgeting, but this time around, we want to look at the effect of inflation on capital budgeting decision. You see that when a business entertain a thought of undertaking a larger project, such as constructing a new building and acquiring a large amount of expensive equipment, it will assemble financial information to test whether the project will ultimately make more money than it cost. So a well-planned and executed budget or capital budget that accounts for inflation is a tool that helps company to make a good decision under this type of a situation. As we are explaining what we mean by capital budgeting. Now, let's look at the real cost of capital. When we are talking of cost of capital, in which we use Capm, that is capital asset price model, to calculate, or in which we blend other costs together with it and call it WACC. So the real cost of capital is what we want to look at now. Inflation affects capital budgeting in a significant way. It makes up a part of market rate of return, and the capital budget reveals the true project cost when using the real rate of return rather than the market rate. So the calculation of the real rate of return begins with the market rate return by subtracting inflation, and this sometimes stated as its inverse, the real capital of the real cost of capital. Now, in this real cost of capital, what is the inflation impact in this? Inflation affects capital budgeting analysis since the market cost of capital is not completely representative of the real cost of borrowing funds. That is why inflation will affect the capital budgeting analysis. However, performing the analysis in a manner that compensates for inflation removes its impact from the result of the capital budgeting, because inflation impact can be removed from capital budgeting analysis by calculating the real rate of return. By doing what? By calculating the real rate of return. The rate of return is what we know as cost of capital. So when you calculate the real rate of cost of capital, you have at least removed the impact of the inflation in it. And let me start again. I said inflation impact can be removed from the capital budget analysis by calculating the real rate of return and using that one for capital budgeting cash flow calculation. And when formulating a capital budget scenario with the real rate of return, the answer has been adjusted for inflation. So when question comes and say that what or which type of the costs that have adjusted for inflation in the capital budgeting, it is what? It is real rate of return, or we call it real cost of capital. And in the inverse, if the rate of return is not adjusted, this cash flow can be adjusted for inflation to match the inflation that is built into the market rate of return. So in either scenario, it is important to make sure that the cash flow and the rate of return are in the same basis, either without or with. We have money cost and we have real cost. If it is money cost, let it be market cash flow or market cost of capital. And if it is a real cost of capital, let it be the one that have been adjusted for inflation. That is what I want you to hold under this. I said for you to be able to remove the impact of inflation in a cash flow, you have to calculate the real rate of return, that is real cost of capital. It is the real cost of capital you will apply in your capital budgeting when you are calculating your cash flow. Once you do that, you have adjusted for inflation. That's what I said. And I also said that conversely, or on the other way around, if the rate of return is not adjusted, if you have not calculated your real cost of capital, if it is money cost of capital, understand? So you can also adjust your cash flow for inflation by matching the inflation that is built to the market rate. If the inflation grows by 30%, you have to let it be built in the cash flow if you want to use the money cost. So in either scenario, just make sure you let everything be equal. You will not use this real cost of capital with inflation, cost of capital that with the cash flow that have been considered for inflation. You not use the money cost, ordinary cost of money cost of capital for inflation that has not been adjusted for. Sorry, for cash flow that has not been adjusted for inflation. Please try to understand this. If you don't get it, what I just want to put across that make sure, or it is important to make sure that cash flow and the rate of return are on the same basis, either with inflation or without inflation. That's on that. And what we mean by inflationary issue? Let's look at inflationary issues. Inflation can be an especially difficult problem for businesses in developing countries, such as Nigeria, because we lack data, we lack capital, we lack statistics. But in the developed country or civilized country, they have data, they have everything, and they have economic that is stable. Understand? But we in developed country is somehow problematic, since in some of our country it can exceed 100% per year at times. As the rate of inflation increases, the investor require a higher rate. What I'm saying is that once the inflation increases, the investor will require higher rate of return in order to compensate for it, which will make the project to be very, very expensive. So inflation, in a nutshell, affect the outcome of the capital budgeting in other way beside the beside the rate of return. And generally, inflation drives up the cost of goods and services, including building material, equipment, and labor as well. Because when the inflation, labor will also want to charge more, and this will increase the cost of capital. And this one may render a project unfeasible to back upon based on the result of the capital budgeting analysis. So that is the simple meaning, simple effect of inflation on capital budget. Now, let's try to demonstrate this. That is a illustration. What we mean by money cost and real cost. Now, what we are saying is that the discount rate will either be real cost or money cost. So, for you to put in the real time, the procedure here is to discount the real cash flow at the real discount rate. You have to discount for, if you want to put your cash flow in the real time, is for you to what? To discount real cash flow with real discount rate. Real discount rate. And if it is money time is to discount money cash flow with money cost of capital or money discount rate. So this is what I was trying to tell you, that you have to let everything be on the same basis. And how do we do this? There's a general formula that can help you to take over this. So the formula is what relates the two bases together. We have 1 plus r is equal to 1 plus m all over 1 plus I, where r is equal to the real discount rate m is equal to money discount rate, and I is the inflation rate. So that's that. So now let's look at the conversion. How do we convert from it? Conversion is not too hard. It's about making the one you want the subject of the formula. Understand? Now look at it now. Let's look at it. Now when we're talking of conversion, so if you want to convert nominal cash flow to real cash flow, what do we do? The real cash flow will be equal to inflation cash flow all over 1 plus R raised to power n. That is 1. And 2, for real cash flow to money cash flow, real cash flow to money cash flow. So money cash flow will be equal to real cash flow into 1 plus R raised to power n. And also, if you want to convert real discount rate to money discount rate, this will be equal to M is equal to 1 plus R close the bracket into 1 plus R, that's inflation rate, close the bracket, everything minus 1. And lastly, to convert money discount rate to real discount rate, it's just equal to, real discount rate to be equal to 1 plus M all over 1 plus R, everything minus 1. What we are doing is to make the one we want to calculate the subject of the formula. It's not more than that. You make the subject of what? Subject of formula. Once you make it the subject of formula, the deal is done. Let me make an illustration to drive home the point we are discussing here. Now, example. I will dictate these questions and I'll just bring out the most important words in it. The question says, a project has the following cash flow before allowing for inflation. What are the cash flow? We have year and we have cash flow. For year is 0. The cash flow is 750. For year 1, we have 330. For year 2, we have 242. For year 3, we have 532. And the question says, the money discount rate is equal to 15.5%, and the general rate of inflation General rate of inflation is what? Is 5%. Evaluate the project in terms of require now. Evaluate the project in terms of 1. Real cash flow, and discount rates. That is real discount flow and real discount rate. And that is A. B. Evaluate it based on the money cash flow and money discount rate. That is what the question says. Now, the first one, which says we should do it based on the real cash flow. The question was given on the money discount rate. So you have to change the money discount rate to real discount rate. See, this is the general formula. 1 plus R is equal to 1 plus M all over 1 plus R. That is, this is inflation. M is money discount rate. R is inflation rate. This is real discount rate. And the question we have, money discount rate is 15.5%. It means that we have 1 plus 0.155 all over inflation rate is what? 5%, 1.05. Everything minus 1. That is a real discount rate. Now, our real discount rate is equal to 10%. So it is 10% now we now use in discounting our cash flow instead of 15.5%. How will it go? Now, see, for year 1 or year 0, 1, 2, 3, the cash flow is 750, 330, 242, and 532. So discount factor now is 10%. This we got. So if that is the discount factor, we now get our present value for discount factor of 10%. For year 0 is 1. We have 750. That is outflow. For year 2, it is for year 1. Year 0 is 1. For year 1 is 0.909. So we have 300. And for year 2, it is 0.826. That one make our cash flow to be 200. And for year 3, it is 0.751. That is the discount rate at 10%. And that one gives us what? 400. So when you add everything together and let it from outflow, what we have is 150. So with 150 that is positive, it means our what? Our project is worthwhile. That is when we use real cash flow. If you want to use money cash flow, remember I said real cash flow has built-in inflation into itself. So you didn't need to adjust the cash flow for inflation again. Understand? That's why we didn't touch this cash flow. Once you have adjusted the real cash flow to 10%, we didn't bother to adjust the money cash flow again because real cash flow has inbuilt inflation. That's what just did it. But if it is money discount you want to know, you want to use, you have to adjust the cash flow to inflation cash flow. Let's see how it is. Now, the cash flow for year 0, 1, 2, 3. Cash flow 750, 330, 242, 532. Now inflation factor is 5%. Abi? Now 5%. For year 1, it will be 5.05. That is 1 plus inflation rate. 1 plus inflation rate will give us, for second year, it will be 1 plus 0.05 raised to power 2. That's for second year. And for third year, it's 1 plus 0.05 for third year. So if we use that one to adjust for inflation, we have a money cash flow. Now we want to know the money cash flow. Money cash flow, it will be 1.005 times 330, and that one gives us what? Gives us 346. This one, when you factor in that, it increased to 267, and the third one becomes 661. These are the money cash flow adjusted for inflation. And our discount factor at 15.5. Now that is the money discount rate. So at 15.5, for the 0 year, everything is 1. So for the first year, our discount rate is 0.866. For year 2 is 0.750, and year 3 is 0.649. So the present value now, our present value is 300, 400, and 200 and 400. So everything goes to 150. So it is either you adjust the real rate, adjust the money discount rate to real rate and apply it to the cash flow directly, or you leave the rate like that, adjust the cash flow for inflation. That is how it is done. I think with this, we have been able to do a good justice to the question. Thanks.